Hey there, welcome to the third session of our course. And in this video, we are going to understand indicators. So we are going to have a look at how they work, what are the working principles behind them, and all sorts of things. But before we dive in, let me tell you that this is a live market. So I tried to take a live market scenario because it will help you even more to understand how indicators work in a live market. Because what happens is when the market is over, it becomes very easy to tell that this had happened or that had happened. When we look at hindsight, when we look in hindsight, it becomes really easy to tell that, oh, you should have done this, you should have done that. But when it comes to live market, it is very difficult to analyze the markets, so that is why I thought, okay, let's go and do a live market session because it will just create a more impact and make you understand indicators even more. Because there are its potential limits and all those things. So indicators have their own limits and potentials, and you have to understand them. It's not like indicators are going to work 100% of the time, or the technical analysis is going to work 100% of the time. It works 60 to 65% or max 70% of the time. Why? We'll all discuss that all later. But for now, let's head to indicators. But before even starting with indicators, I want to clear the concept of how indicators work or why they work. So I want you to imagine this one example that you're driving a car on a highway, all right? And your friend is driving ahead of you. You do not know where the road is leading. You do not know the destination. Your friend knows where you guys have to go. You are following him, and then there are two turns in front of you. There's a left turn, there's a right turn, and there's a straight road ahead. So there are three directions for you guys now. And now your friend gives you a left indicator on the car. He starts to blink left indicator on the car. So what are you going to derive out of it? You will derive that your friend is going to take left, right? Right. When he gives right indicator, you are going to derive that he is going to take a right, isn't it? And what if he gives no indicator at all? Then you are going to derive that he is probably going to go straight, isn't it? So this is how indicators operate in our day-to-day life and even in markets. But what happens is it has their own limitations. What are the limitations? Like, see, while driving, you must have noticed that people unknowingly just keep their indicators on. Like गलती से हाथ लग जाता है, or they don't even know about it and the indicators are on. Like if a car wants to go straight but still has a left indicator blinking on the road. Now you might think, you are behind that car, you might think, okay, this guy might turn left, so you will take your stance accordingly on the road. But then you see that, oh no, he's not taking a left, he's instead going straight. So this is what happens when this is basically the limitation of indicators, that in real life people are unaware that indicators are sometime on, so that can create a mess sometimes. Similarly, technical indicators also have their own limitations that do not expect them to work 100% of the time, because they do not work 100% of the time. Technical analysis is something which works mostly only 60 to 70% of the times. We'll discuss all this why later, but nothing in market works 100% of the time. Leave 100, it is very much difficult to attain even 80% of accuracy in market. So uh, even if you are a technical analyst, or even if you are a professional technical analyst, you probably are going to lose 30% of the time despite being professional, because technical analysis is it does not basically work 100% of the time. We'll understand all this whys later, but this video is going to be the last video of our basic analysis. So what does basic analysis include of? It includes of candlesticks, candlestick patterns, price action patterns, the patterns we saw in the last session, and then the indicators. So here the basics of technical analysis gets complete. And after this, from next session onwards, we will be diving into understanding Fibonacci retracement extensions, time frame analysis, multi-time frame analysis, and option chain, open interest, and all those things. So those things are a bit on the higher side. They are a bit advanced level analysis of technical. Okay. And then we have position sizing and risk management. So before we I mean, I won't put that on the end, the risk management and position sizing, because it is important. So I might shuffle these topics. It might not be the same as I said now. But yes, so here the point is here the basic analysis is coming to end. After this session, we'll start with advanced analytics. So let's understand indicators. All right. So this is a live market, okay? And as you can see, the candles are forming. So this is a 3 minute chart. So what is a chart? You know what is a chart, but this is a 3 minute chart. What does that mean? That you can select the time frame over here. So 1 minute, 2 minute, 3 minute, 4, 5, 10, 15. And whatever time you choose, a new candle will form every that minute. Like if I choose 5 minutes over here, then a new candle will form every 5 minutes. Like see, which means now if you can see the time is 11:34 and this candle, as you can see over here, it started at 11:30, so it will end at 11:35, and now the 11:35 candle has started because 11:35 is on the clock, and this candle will end at 11:40. So because I have selected the time over here as 5 minutes, this is every candle on the chart is going to be of 5 minutes. Similarly, if I take 10 minutes, every candle is going to be of 10 minutes. So from 11:25 to 11:35. From 11:35, now this candle will end at 11:45. Then a new candle will start on 11:45, which will end on 11:55. So forth, so on and so forth. So let's understand. I am used to this 3 minutes time frame. So let us analyze it on 3 minutes only. But before we start with indicators, I want you guys to have a look at how these candles are getting formed. So for now, this candle came down. It opened up over here, it came down, and then it is going up. So as we saw in the first session of candlestick, what candle does this mean? This is a bullish candle. Why? Because the bears tried to push it down, but the bulls covered it up and took it up again. But again, now the thing is, where is this candle occurring is more important. So I talked about the context of things, and this is where the context kicks in, that whether this candle is occurring at a support level or just randomly popping up out of somewhere. So as you can see, in the last session, we understood support and resistance. So this level is acting as a support for now, isn't it? Can you see it? This, see. So the markets were coming down, but it stopped over here. Then, and if you can guess what pattern is this market making right now, just try to guess it once. We understood patterns in the last session. Yes, right. So it is kind of making a double bottom pattern because see from here one, two, 3, and now it might go like this. It is all a game of probability, so we cannot just say that okay, it has formed a double bottom, so now it will attain this target or these level. But yes, this is how technical analysis works. This is how it is supposed to work. And now if you can see, now if you can figure out where the neckline of this particular thing is, so here is the neckline because market fell down, it took a support, then it went up, took a resistance over here. So wherever it takes a resistance after taking a support here, we can call that thing a neckline. Again took a support over here, and now this candle was the most effective candle because see, we knew here the support was, and after that this candle was formed. What does this candle say? This green colored candle, it says that it has a wick, which means the markets opened over here, came down, but the bulls said no, the support is here, we are not going to let you take the markets down below this level, and the bulls pushed it up. So here we got this bullish candle at support, and now as you can see the markets are heading up. So this is how the technical analysis is supposed to work. And over here, we are not using any indicators to analyze markets. This is price action. Okay. What is price action? Price action is basically the action that the price fluctuations show to us. So what are price fluctuations? Whatever that's going on your screen right now, up, down, these are price fluctuations. And the action that is these price fluctuations do is called price action. So by the help of price action, we can analyze markets as well. So these patterns are called price action patterns for a reason, because they do not take help of any indicators or so. That is why these patterns are called price action patterns. So I hope you're getting how to use these candles and how to use those patterns. So as of now, you shouldn't be going long right over here because the neckline is not broken yet. So the moment it breaks the neckline, you can initiate a long. All right. This is how the patterns work. This is how technical analysis work. But we'll understand price action later on. But for now, we'll understand indicators. Okay. So for now, let's clear the charts and let me give you an idea of how to add indicators. So this is the kites platform, the Zerodha kite. And when you open a chart, you can see studies over here. Okay. And here you can find tons of indicators. So you can add whichever you want to. So in today's video, we are going to see RSI, which means relative strength index. Now, because the relative strength index thing is so hyped, because people keep using it and it does not work according to their expectations. The primary reason being they do not know how to use RSI. There's a way to use RSI, and the way people are using it, the way YouTubers are telling that this is how you use RSI is wrong. That is, I mean, I will tell you that in detail, but I just want to tell you that people on YouTube are giving free knowledge, but the point is, free knowledge is not always the right knowledge. Okay, because YouTube is free platform and it does not need any verification. uh, so anyone can make any video, and because of that people are making videos for views so they can make money. And to attract more people, they are making videos on topics they do not even know about. And what ends up happening is they give up free knowledge. Sure, they give free knowledge, but they give wrong knowledge. So we should avoid that. So even if you are following someone on YouTube, make sure that that guy is really a guy who is giving you the right knowledge, because just because it's free does not mean it is good. So we'll understand RSI, then we will understand VWAP. RSI is relative strength index. VWAP, VWAP is volume weighted average price. Then we'll understand simple moving average. Then we'll understand exponential moving average. Then we'll head on to understand stochastics. Then we'll understand pivot points, and then finally ADX. So these are some indicators we are going to have a look at. These are top indicators, and that is why I want to cover these indicators in particular, and not all of them, because it is going to take a lot of time, like 10-15 hours to explain you all these indicators. So, and there's no use as well, because you're not going to use all these indicators, right? So first, let's start with understanding the indicators. But indicators come in two types. So you need to understand what kind of indicator you are using. So there are leading indicators and there are lagging indicators. So what is a leading indicator? Leading indicator is basically an indicator that is designed to give an output before even the market performs, which means any indicator uh, that will tell you where the markets are going to go in upcoming time is called a leading indicator, because it is based on the fact that it is based on assumptions that market will follow that particular pattern or that particular trend, and before even market moves in that direction, that particular indicator tells you that this might be the upcoming move. So that is a leading indicator. And then we have lagging indicator. Now, what is a lagging indicator? Well, lagging indicator is an indicator which follows the price. Okay, so leading indicator goes ahead of the price, but lagging indicator follows the price. What do I mean by following the price? Which means after the price action has showed its fluctuation, the lagging indicator will display it in there. So it will not show you where the markets are going to go, but it lagging indicators are basically used for trailing your targets, or mostly understanding how long this trend is going to last. So we are going to have a look at both of them. And starting off, we have RSI. So RSI, you put in RSI over here, or I guess the relative strength index is the name. RSI. Where is RSI? Over here, right? So what we got over here? So now you need to be attentive. All right. We have market. This is Nifty futures chart, September months, and as you can see, we have a good positive trend. Okay, a good positive trend and a sort of retracement over here. So for now, What is RSI? So RSI, as I said, is relative strength index. This is a leading indicator. Okay, RSI is a leading indicator, which means it is trying to assume where the price is going to go in upcoming time. All right, let's switch to 5 minutes because most people might be comfortable with 5 minutes rather than 3 minutes. Now, as you can see, we have our settings over here. As we click on this RSI, we have settings period. What does period mean? Period is 14. Period is 14 means this RSI value that we are getting over here is of last 14 candles. Period 14 means the last 14 candles it is going to take into consideration to give the output. Okay. And then we have overbought zones and oversold zones. So what is the overbought zone level? It is 80 and oversold zone level is 20. I want to change these settings. I want you guys to change that settings as well. From 80-20, let's do it 30 and 70. 30 and 70. Now, as you can see over here, the oversold and overbought zone. So 70 level is overbought zone, 30 level is oversold zone. So what the concept of RSI is that whenever RSI goes into overbought or oversold zone, there is going to be a reversal. All right. This is the base concept of RSI. Whenever let's take it again. Whenever RSI, the value of RSI goes into overbought or oversold zone, then it is expecting a price reversal. Now, this is how the bookish RSI is taught to people. This is how the YouTubers are telling to people to use RSI. But let me tell you, there's a much better and a practical way to use RSI, at least when we talk about intraday trading. All right, what is that way? So RSI, as we said, is a relative strength index, which means it does not tell you what the current strength is directly. It will tell you the relative strength. So whenever RSI goes into overbought or oversold zone, my technical analysis says, or my observation says, or my experience says, that is exactly where the real move starts. That is exactly where the real move starts. People are expecting a reversal. That is the exact reason the move should start over there. Now, this is a controversial statement because many of you might have heard about RSI of using it that way, that when it goes to 70 or 80, start selling, and when it comes to 20 or 30, start buying. I do, whenever I use RSI or whenever I advise people to use RSI, I tell them to do the exact opposite. Meaning, whenever it goes into 70 level, you have to look at the context of the chart and start buying. Now, this is a controversial statement, but it works fabulously. Let me display a one example right in front of us. So, as you can see over here, we had this resistance. All right, this was yesterday. So we had this resistance over here. Market were going up. We had this resistance, and then what happened? Market took another resistance on the same line. So don't get surprised by this because this is how markets work. A support acts as a support for another time, a resistance acts as a resistance for next time. So market took the resistance over here, took resistance again over here. All right, and then what happened? Markets broke above the resistance. So the resistance was not a resistance anymore. So if this candle, you can focus on this particular candle, it broke above the resistance, right? And then you have to see where the RSI was. RSI was at 66. All right, RSI was at 66, which means RSI is going into overbought zone according to people. So people are getting ready to sell as soon as it hits 70 or 80 level. Now this is where you have to be understanding concepts and context of chart. So what happened here? There was a resistance. Now you have to understand the thing that the trend was positive. So the trend was positive, the trend was with you, and it broke resistance. So what happened? Positive trend plus a breakout plus RSI going up. Now you do not have to view RSI from overbought or oversold zones perspective. You have to look at RSI from a momentum point of view. This is where momentum kicks in. This is no one is going to teach you RSI like this on YouTube, because this is not how people use RSI. And then they blame that RSI is overhyped and it does not work. Well, it does work if you know how to use it. All right. So the trend was with us. The trend was positive. So what, understand, start gathering the context of the chart. What were the context? Number one thing was positive trend. Okay. Number two thing, there was a breakout. Okay. Number three, RSI going up. So we have 70 level marked as our zone, and 30 level, I won't say overbought and oversold zone. I would say buying zone and selling zone, because we are doing exactly opposite of what usually people do. I would say this 70 zone as a buying zone and 30 zone as a selling zone. So we have positive trend, we have a breakout, and then we have RSI at 66. Now you might say, okay, I will wait until it gets to 70. Fine enough. After 2 3 candles, it goes to 70. What you should have done? Buy. Buy the markets. Getting my point? This is how momentum trading works. Now, mind you, this was 2:45 in the afternoon, which means there was only 45 minutes of time before the markets are closing on this particular day. So people are like, "Arey, what is going to happen in last 30 and 40 minutes? Move is already done. So nothing is going to happen." But as you can see, the momentum, the chart, the technical analysis was trying to say positive trend plus breakout plus good RSI is equals to what? Is equals to momentum. And see these huge candles. Momentum came right just then. People start to sell over here because they see RSI is overbought. But that is exactly why people get trapped, because operator is busy buying in these over so-called overbought zones. See, the market today opened in overbought zone only. It opened only overbought zone. So what is that supposed to mean? The so-called technical analyst will say sell over here because it is overbought. If you had sold in the markets over here, you would have gotten a hit. The markets went from 17,140 levels to 17,230. That's a 80-point up move right in the morning in first 30 minutes or so. People might be thinking this is overbought. Heck no. This is the momentum. And then when it went above, the RSI went above 85, 90. It didn't go 90, I guess. It went, okay, it went 85, 86 levels. Now this is where it gets confusing, because that is why I told you to change the value from 80 to 70, because our main zone where we are going to target RSI is from between 70 to 80, or rather 70 to 82 at max, because after that it really becomes overbought at times, like as you can see over here. Now the so-called technical analyst will say, okay, we told to sell you over here, you did not sell, and see the market fell. Okay, it did fell, but what about this 80-point move? You are not going to consider it, or what? Don't you have a stop loss? You cannot just sell markets or buy markets randomly and say it is going to go up or down. You need to have a stop loss, right? And no matter how big your stop loss was in this move, if you sold over here or here, it was going to get hit, because it was a 80-point move. It was not a 8-point move. So when it started to go above 85, okay, that is when it started to face some heat. It started to face some resistance. Okay, so here we saw a pattern, a technical pattern, the candlestick pattern. We saw this pattern when we, in the first session, when we understood candlesticks. So now mix it with all the context of the game. First we had uptrend, then we had a breakout in the last day, then we had a momentum, then we had markets opened gap up with momentum, then we had this pattern when RSI was above 85. What does this pattern say? We do not need to remember the name of the pattern. a green candle followed by a red candle followed by a red candle that gave a closing below the low of this candle. Remember, closing above high of any previous or previous to previous candle or below the low of it, which means bearish sign. Now this literally was a reversal sign. Market was screaming at you to get out over here. RSI was 85, so that was what you can say. Now it was in overbought zones. Above 85, I would say it might be called overbought because sometimes it even goes 90. Okay, sometimes it even goes 90. So that is just the perspective of how markets are behaving. You have to understand that when trading and making live decisions. But for now, high RSI, we had our momentum, right? We had our momentum from here to here. So it is not like RSI did not work. It did beautifully. It worked beautifully. And after that, we had a reversal sign with high RSI. So now you can take a exit. But you have to be attentive and conscious of what is happening. Because if you see this pattern and still do not react, then probably you're going to lose like this. All right. So high RSI does not necessarily mean overbought because there are instances and examples where I have seen RSI reach 92 and 93 levels. So what I would advise is do not blindly exit based on RSI. Search for such reversal patterns even when the RSI is above 85. Okay. And where our entry point is going to be, it is going to be at 70 zones. So if you get any long or any context of going long along with RSI at 70, you can definitely go long and should not exit until you get a reversal point. Like, what if the market kept on going up until here, here, here? So you would have regretted, right? So that is why you have to trail the market, you have to follow the market and do not have to take decisions based on your own. So when you get reversal patterns like this and when the RSI is also high, then you have to understand, okay, Baba, this might be my chance to exit. Get out or markets will punish me later. Okay. So now let's see what is happening in current markets. Okay. Current markets, this is the support zone. Look carefully. RSI is dropping. RSI is dropping. This is the current support level. Exact thing what we faced here. Okay. So for now, the momentum is negative. We have a support. Market is about to break that support and RSI is dropping. What are you going to do? Now, this is where you cannot think much. You do not have time. As soon as it breaks and gives a close, we are going to short markets, meaning we are going to sell the markets first and then cover them later. What is going to be our preferred target zone? This is going to be target number one because this is the support zone now. Whatever that had been acting as resistance acts as a support when the resistance is broken, and whatever that is acting as support acts as a resistance when the support is broken, which means, let me give you a example. Markings. Where is doodle man? Okay, so now we have support. If the market breaks below this and comes back above over here, now this level is going to act as resistance and then it will fall back again. This is how markets operate. Once a support is broken, it acts as resistance. Once resistance is broken, it acts as support. So here the live market is breaking down below this particular support zone and RSI is dropping. We need to see a body close below this particular candle. Now body close is, again, uh, it depends from person to person. You can have a body close, wait for the body close, or you cannot. It is just, it is safer, it is conservative if you look for close. But I myself, when I trade, I do not look for close, I look for the breaks. So I would have just shorted markets right over here, not doing it because this is not my main account. I do not have many funds over here. This is just to explain you guys because uh, this UI is pretty simple. Now let's see both perspective. What if we short the markets as soon as this candle goes below this? Meaning we do not wait for the body close. What happens after that? So in this case, What I'll do is if I short the markets before the closing of the body, I will keep my stop loss very aggressive, meaning I won't wait for markets to come over here, or won't keep my stop loss over here. The technical stop loss has to be over here, right? Above the high of previous high, above the previous high. So I won't keep my stop loss over here. What I will do is, because the body close is not there yet, it might happen that market can trap people and go up. So we got a close over here. That is fantastic, which means we are great to short right now because support has been broken, momentum is negative, RSI is falling. But in cases where we do not get a body close, I won't keep a stop loss over here above. I will keep it over here just to be safe and aggressive. So I do not want to lose much more money when I'm wrong. I want to lose less money when I'm wrong. Okay, now what is happening? Now we have a body close over here. The momentum is negative, RSI is dropping. So we need not have our stop loss over here. We can have our stop loss somewhere over here or here. Because what happened now, if you can see, this particular support zone is acting as a resistance. So market is struggling to go above this particular level. This is how technical analysis operates. Something that was support previously, once broken, acts as resistance. Something that was resistance acts as a support. Okay, so the markets are coming up. Need not worry, this might be a trap as well. So all you have to do is follow your analysis. Like you have your trade, you have placed your stop loss, you have placed your target, then just forget. Okay, so let's understand second indicator now. You have got the point, right, of RSI. Similar to what this overbought and oversold zone is, we call it buying or selling zone. Like the selling is 30, selling zone is 30, the buying zone is 70. So whenever market is giving you a context of buy and is near to 70 levels, what we do, we just buy. Whenever market is giving you a context of sell and is near to 30 levels, what we do, we sell. Now here is where we need to exit. Okay, why? Our stop loss is not hit. Yes, it is not hit, but this is a reversal, this is a trap. So you need to understand when the markets are trapping you and when they are actually giving you a move. So as soon as it gave a close, it made a new huge candle. A buying pressure is coming, that is just breaking through this resistance and going up above. So now if you have any shorts over here, what you have to do, you just have to cover your shorts somewhere over here so you do not lose more. The point of trading is to lose less when you lose and to win big when you win. So and what is the what happened to this RSI? So that is why I told you in the start only that these things work only 70% of the time or so, 60 to 70%. They do not work 100% of the time. It is a game of probabilities after all. So and what happens, and when if this particular thing comes down below the low of this candle now, the low of this candle, if this comes below the low of this candle, that is where we can again initiate a short. Because what this candle will mean that people sold over here, this is going to trap people. And if it does not wants to go up, if it wants to go down, then it will hunt those stop losses the people have kept over here. It will hunt all those stop losses and then fall. And when it comes down again, you do not have to hesitate to create another order to short the markets again. All right, getting it? Yes. So let's now understand the second indicator. This was RSI. This was RSI. So we will understand VWAP now. Okay. What is VWAP? VWAP is basically volume weighted average price. You do not have to understand those terms. You just have to understand the fact how they work. So VWAP is basically a line that differentiates who is controlling the markets right now. If the markets are above VWAP, this red line you are seeing on the screen is called VWAP. So if the markets are above VWAP, it means the bulls are in control. If the markets are below VWAP, it means The bears are in control. So as you can see, uh, it acts as a support and resistance, but it is moving along with the markets. So we call this thing as a dynamic support or resistance, which means it keeps making new support or resistance depending on how market is moving. So once it broke below this VWAP, as you can see, it took a resistance over here exact on the VWAP level and then fell below. All right, are you getting it? So this is how VWAP works. Now to get even better idea of VWAP, what we can do is we can switch to volume candles. So we have display over here, go to display and go to volume candle. You can search over here volume candle. Where is it? Volume candle. Don't get confused. It just changes a pattern a little bit, but the technical analysis and all stuff remains the same. So the thing is, whenever market breaks the VWAP with a volume candle, how do we define a volume candle? So the width is what defines the volume. Any candle that is wide enough says that it had volume. Such candles, the thin and small candles, say that they did not have any volumes. So these all candles had volumes because they were wide and they were having volumes. They were displayed like this. So any candle that does not have volume will look like this small candle. See this current forming candle. Okay. So whenever market breaks the VWAP zone with a volume candle, you can initiate a long or short depending on what side it is breaking. Like today morning only 9:20 a.m. candle broke above the VWAP with huge volumes. What you can do is you can buy right over here, keep stop loss below the low of this candle and then keep trailing your targets. It worked out beautifully. Then what you can do is when the market went below VWAP with volumes and gave a close. Now in this case close is important because wick is not going to help you. In this case body close is very important in terms of VWAP. So the markets came below, you get a good volume close. What you can do is initiate a short over here, keep your stop loss over here about this high and then let the markets run. So you're getting it. This is how VWAP works. You can just rewind this particular part if you want to, but there's nothing much to get confused about. It is pretty easy. And when we are not using VWAP, we would switch to normal candles. Okay, so candle, the pattern remains the same. It just becomes wide or thin depending on the volume it had. Okay, so here we can see a selling pressure is occurring, which might say that this move was a stop loss hunting move. This move came just to hunt the stop loss of people. There's nothing you can do about it because we all operate on the same basis. But what you can do is lose small when you do, and if the markets break below this particular point, initiate a short again and keep stop loss above this high or whatever the high it is making right now. And that would be a very high probability trade. Now the reason behind this trade is not working as usual is because the markets are in a huge uptrend. Now if we go to Nifty 50 chart, the spot chart, and see the daily chart of Nifty, as you can see, it is a huge uptrend going on. That is why the short sides trade are not working as they should. Uh, I mean, they are working well, like you saw over here, the VWAP breakdown and stuff, but they are not working as they're not working as they usually do because in a huge bull market, short trades are difficult to execute and to analyze because the trend is basically positive. Like, although today the momentum is negative, but if you can see, the trend is really positive. And in positive trends, many a times market likes to trap the opposite direction traders. All right. So that is why it sometimes does not work as usual. when we are against the trend. That is why in the last session I told you to be with the trend and not be against it. So now this candle is making it clear that this was a stop loss hunting only. This move was nothing but stop loss hunting. So yes, now if it goes below this candle, you can create a short and keep stop loss over here. But again, you have to keep the thing in mind that we are against the trend. So anytime it can trap people like us who are against the trend. The reason I do not like to trade against the trend is this, that it can trap us anytime. uh, I mostly like to stay with the trend, and whenever I am against the trend, I like to scalp, which means I like to get in and get out immediately without waiting for big targets. Now let's see how this particular trade turns out. If this goes below this particular low, then it might show us a good down move, because this is literally a signature stop loss hunting move. Like people sold over here and had stop losses over here, went up, took their stop loss and came down. So this is a signature stop loss hunting. We'll have to look how it performs, because the trend is positive. So I'm not a really optimistic on this short, but we can get a good down move until this point, 17068, because that is where the previous support was. Sorry, the resistance was, which will now act as a support. So let's keep this VWAP aside now. I hope you have understood. And let's now move to next our next indicator, which is moving average. Now as we click on moving average, we get settings. So what are these? Again, the period here means the same as the period meant in RSI, which means this is going to consider the number of candles to give the output. So if we click 50 over here, it is going to consider last 50 candles to give the output. If we click 20 over here, it is going to consider 20 candles, last 20 candles to give an output. So it depends on what kind of moving average you are going to use. This is simple moving average. Then we are going to learn about exponential moving average. But in simple moving average also, you have this multiple options of choosing the number you want. So the famous moving averages are the 9 the 9 moving average, the 21 moving average, the 12 moving average, the 20 moving average, the 50 moving average, 100 and 200 moving averages. So for now, let's use 20 moving average, and let's keep red line to indicate where the moving average is. So moving average work very similar to how VWAP operates. VWAP basically says who is in control. Moving average is very similar kind of stuff to give you an idea of who is in control. And moving average acts as a dynamic support and resistance as well, like VWAP did. So as you can see over here, market continuously took support of this 20 moving average and went up. Took support, went up, took support, went up, took support, went up. Broke down. Now this is where the trap was. It broke down, made people believe that it is going to go down and went up. Why? Because the trend was positive. So this is what happens when you trade against the trend. That is why I do not advise to do that, because market keeps on trapping us like it just did in this particular example. Like we virtually sold over here and market trapped us. So that keeps happening when you go against the trend. So again, over here, it broke down below. People thought that it might fall now. No, it went up. So this is how it works. It works beautifully. Now, when you might ask, okay, it did not work here, but why was it working over here? Why did it work over here? So to understand this, we have to go back to RSI. All right. So we had high levels of RSI with this reversal pattern occurring over here. So that was the context. And then it broke down below this level, and then people went negative. Then they went pessimistic about the movement of the market. Then it went and touched and checked this moving average, just resisted over there. Exact, you can see if the levels are exact resistance on the moving average, just like it was taking support over here, and then fell down. Now currently the market is below moving average. So what we can do is, in a trend like this, where the trend is huge positive or huge negative trend, we have a huge positive or a bull run going on. What we can do is we can wait for market to give us a up move rather than shorting the market. So I personally prefer that. So whenever we get an indication of up move, we will go long, but whenever we get indication of down move, we will not short the markets but only exit our current positions if we have our longs. All right. So what moving average basically tells you is how the markets are currently going. Now this is a lagging indicator, which means it will move according to the price action. RSI was a leading indicator, which means RSI is literally telling you that the market can come over here. Moving average is basically lagging indicator, which is telling that, okay, I am following you and currently this trend is going to last, or these guys are in control. So like VWAP, when the market is below moving average, you can conclude that the market is a bit negative, and when it is above moving average, you can conclude that the market is positive. And then we have the moving average crossovers. Now what is a moving average crossover? Now we have moving average set of 20. We add another moving average, let's say of 50. We'll change this color to pink. And whenever now these two moving averages we have. Now what happens is, there's a concept called slow moving average and fast moving average. When we add two moving averages like this, the slow moving average is going to be the 51 because it is a bigger moving average. It takes consideration of more candles than this one. So this is going to move slower. This is going to give results slower. So this is a slow moving average, and this is a fast moving average because it is considering lower number of candles, and that is why its output is going to be dynamically fast as compared to this particular moving average. So we have a slow moving average over here. We have a fast moving average over here. So what the concept is basically, this concept is called moving average crossovers. So this concept is basically whenever the fast moving average crosses over the slow moving average in any particular direction, we have to take a trade, or rather it tells us the upcoming direction of the market. Like the slow moving average is getting crossed by the fast moving average. So the fast moving average, the 20 moving average, crossed below this 50 moving average, and now it is indicating, the moving average is indicating the markets may fall more. The markets may fall more because this is a very pessimistic crossover. This is a negative crossover, because when fast moving average crosses slow moving average, this is a negative crossover. Now to understand it better, can we combine multiple things together? Like now, let's add one more indicator that we learned just few minutes ago, RSI. Now as you can see, RSI is going to drop below 40. Moving average is telling that, okay, the kind of situation the market is right now is slightly negative. And then we had this particular level where the market hunted the stop loss. This level, sorry. This level was a support. What am I doing? Let me draw a straight line. This particular level was a support which market broke and it hunted those stop losses. What happens now? It is breaking that support again. All right, so now you have to see what is the context. This was the support, it broke below, it took the stop loss, and now as I said previously, this level is very important. If it breaks below this level, we might see a move coming until this point, and if it breaks below this support as well, then this level is where I see market coming next, and then finally this. Why? How am I deciding these levels? I am deciding these levels based on the fact that market reversed from those particular levels in the past. So as you can see, this was a level where market had resisted previously. So this acts as an important point for markets. So what is the level? 17070. After that, there is no support until this point. So this is where the market had reversed from. So this level 17027 is a very important level. And then after that, this level, the low of this candle, 16995 is another important level. So this is how you form levels. This is how you understand the level trading that is there. For now, the context and whatever that's going on in chart is negative. There's a moving average negative crossover. There's this support all that is almost going to break down, and then the RSI is negative as well. So what happened here was market actually just hunted those stop losses. Okay. So if it breaks below this, it might actually try to hunt these stop losses too. But the possibility now is quite lower of stop loss hunting because it is already done. So in such cases, when the market breaks below this, you can keep stop loss over here and wait to see what market is trying to do. Yet the support is not broken, but we'll see how this performs over time. All right. So now we have a context of things that negative momentum since morning, negative breakdown, and then RSI coming down as well. So this is a negative context, but I would still not short here because although it might go down, as I said previously, like to trade with the trend. So rather than shorting in a heavy, crazy bull market, I would like to stay on the sidelines, and I'm fine missing such trades if I have to miss out on them because there are so many good trades that we get on the long side that we do not have to execute each and every trade we get. Just focus on those good trades. This is not a bad trade, but the fact that the trend is positive makes this a slightly confusing trade to take. So this was another crossover here. So the market had a crossover here. This was previous days, and this was a negative crossover because fast moving average crossed below the slow moving average. We got some down move, but then what happened was it gave a positive crossover. So this is the kind of crossover we should look at and stay along with the trend. Even when we get negative crossovers, it is not like that we are not going to have short moves or down moves. We are going to have, but rather than focusing on down moves in an uptrending market, it is very much better to focus on uptrending moves in an upgoing market. So this is when we got a good upgoing crossover. This is a positive crossover. Why? Because the fast moving average went above the slow moving average. RSI was above 60 levels over here, and then we had a crossover as well. So in these situations, you have to take the context of various things and understand how things are working, and then you can see the market continuously went up. So let's see what the current market is doing. Okay, it is breaking down below this particular support. It broke down. Okay, let's observe now. Let's observe what happens. Our support was this. Market has broken down below it. Context is negative, but remember the trend is positive. So we need to be cautious even if we are shorting over here. Stop losses has to be over here because this is the point where the market previously hunted those stop loss and reversed from. So for today, sorry, so for now at least this particular point becomes the high of this candle becomes very important to us. All right, so let's see what happens, and until then we'll head on to our next average indicator. So I hope you have understood this moving average concept, moving average, and then we have moving average crossover. So you can play with multiple levels over here, like you can change from 20 to let's say 50, and then the slow moving average from 50 to 100, or anything that you like. So you can play around with these levels to see how the market is doing. So we have our 50 moving average over here, and we have our 100 moving average over here. So 100 moving average is also a good support. It acts as a good support. 50 moving average also acts as a good support, but 20 moving average acts as a good dynamic support for intraday trading in specific, in particular. So similar to this simple moving average, this is a simple moving average. We have exponential moving average. So EMA, what we call it, exponential. Okay, we have to change the settings only. Moving average, let's add moving average. I forgot. In other trading platforms like TradingView, we have to search for exponential moving average. I forgot that. I use TradingView a lot. So yes, so here we have Let's do it 20 for convenience sake and then close. Now this is where I forgot to tell you that this field needs to be close only. If you do it open, then the moving averages will give the output based on the values of openings of candle, but we are more concerned with what happens with the closing. The close of the candle is what is important, so we have to put close over here. And in type we have simple. This is where we have to do exponential. So here you can see exponential, put exponential. What exponential moving average does is it sticks to the market more. Like if a 20 moving average is giving you a kind of dynamic pattern or dynamic line, this is basically a shrinked simple moving average. So let me add a simple moving average as well so you can understand the difference between those two. I will color it black. So as you can see, the simple moving average is giving a bit of space to market to behave and act accordingly, or it is giving a bit of space for price fluctuations. Exponential moving average is about shrinking the markets and keeping tight with the markets to get a good grip for scalpers, for people who want to have a sense of direction on immediate basis. Exponential moving average is good. Like if you are not able to hold on to your profits for long, or you are having problems with understanding markets on a larger scale, then you can use exponential moving average, because there's not much of difference, to be very honest. It is all the same, but this is just a bit of shrinked version of simple moving average. So as you saw, the simple moving average was giving a bit of space to market. This is also working the same, just not giving much of space to market. So as you can see, the markets are taking support on exponential moving average as well, but it is basically a shrinked version of simple moving average. The working principles are same, just a shrinked version. So similarly, we can have a exponential moving average crossover as well. Works the same way, works the same way. The concept is same. There's nothing to be changed in here, works the same. But as you can see, the 20 moving exponential average is exactly where the markets reversed from. That is exactly where it hunted the stop loss just few moments ago. See this high, because what happens is once the market starts to go above this level, above this moving average, people start to consider that the bulls are in control. So this was just a stop loss hunting, na? The people who were hunting people's stop loss, the professional people, the institutions, did not wanted to take the market up. They just wanted to hunt these people, but still keep the markets down. So what they did, they took this particular price until exactly moving average price got rejected from there. So they hunted until this point and then took it back again. So as you can see, it broke this level as well, but it is not giving the kind of momentum we are expecting, because again the trend is positive. These problems occur. The lack of momentum is there. The kind of surprise market shows, that is there. So you have to deal with all these things when you are trading against the trend. So it broke for a moment and then it came back up. So this is confusing at times, and that is why I prefer to stay on the sidelines when we are going against the trend, because it traps a lot of time. Okay. So now we have learned about RSI, VWAP, simple moving average, exponential moving average. Now we'll learn about stochastics. Stochastics. So there are multiple stochastics indicators, like stochastic is there, stochastic RSI is there. This is a combination of stochastics and RSI. Stochastics divergence is there, momentum index is there. I'm not going to explain you all of this because it just gets confusing. I'm going to explain you only stochastics. All right. So here we have stochastics. Now you can imagine stochastics as basically a crossover of moving averages that shows us the momentum. Now this is again a leading indicator. Moving averages was lagging indicator. Stochastic is a leading indicator. So it is basically kind of moving averages, but trying to show where the market is going to go. So moving averages, what they do is they try to follow the price pattern, or the price action. But stochastic is kind of being a moving average, but still trying to figure out where the price might go. So it works on the concepts of crossovers, similar crossovers, the black line and the red line. There are settings. Again, we are using the default settings that are there. So whenever this black line comes below red line, it gives a selling indication. And again, the levels are, as you can see, of same 80 and 20. So if you want, you can just modify these levels to 70 and 30 like RSI. Yes, that is how I uh, like to use those 70 and 30 levels. I like them a lot. So now the basic concept is again same, that whenever a fast moving stochastic line passes a slow moving stochastic line, it is going to form a kind of or give a kind of indication that this might be the upcoming trend. So, but the problem with stochastics is that you are seeing on the screen right now, it gives multiple fake signals as well. So this was the only signal that it gave today, which actually worked out. So as you can see, this reversal pattern was there. We saw it, but this was a major reversal pattern because RSI was oversold, sorry, overbought. This pattern we got over here, and then the stochastics also told that it might fall down. It was a major reversal point, but apart from this particular trade, you see it gave multiple fake signals. See, it told to buy over here after this green candle, and it went down. Told to sell over here, it did work for a bit, but did not really because it went into consolidation. And now again, it's telling to buy, sell, buy, sell. So stochastics can get confusing if you use it on its own. So when you use stochastics, you always have to make sure you are using something else to support that thing, because stochastics on its own will make you very confusing. So you can use RSI, you can use moving averages, or you can use VWAP. So I will give you an example. Like let's use VWAP. So as you can see, the VWAP was negative over here. Okay, we had a reversal pattern over here. RSI was oversold, overbought. Sorry, I'm talking oversold. It was overbought. RSI was overbought. We got a rejection pattern. VWAP gave a good volume closure, and stochastic was negative as well. So when such confluences come together, multiple confluences and context come together, that is when you can take advantage of it. So VWAP was negative, this was negative, RSI was negative, we had negative momentum starting in our favor. This zone is where you can just short the markets if you want to. Again, I'm not recommending because the trend was positive. But this worked today. Sometimes it works, sometimes it doesn't. But to stay with the trend is basically good. It is great to stay with the trend rather than just going against it. So do not use stochastics on its own. It is a great tool to be honest, but only when you use it with something that is supporting it. So again, see right now here what we had. We had a market breakdown below this support level, and then the market is going up again. Ta-da! So this is how trend surprises you. Broke down two times and still not falling. This is how trend surprises you. This is why staying with the trend is important. So even if you're using RSI, the concept is same. If this particular black line comes below red line, you have to sell. I mean, you don't have to sell immediately, of course. It just gives you a context and sense of direction where the markets might head. And when it goes this like this, when it goes above this red line, the black line, when it goes above the red line, it is telling that it might head in positive direction. But as I said previously, if you use it alone, it is going to create a lot of fake signals. So do not use it alone, use it with something else like RSI or VWAP. All right, so let's now move to our next indicators, and that is pivot points. So pivot points are basically ready-made support and resistance levels. They work fantastic and they are ready-made support and resistance level. For today, like see today, the market started opening up. Now this is where you can gather a lot of context. All right. So this was a resistance. Pivot points come in support and resistance zone. So you get three pivot points on each side. So this black colored point is a pivot point. Below black color is this green color. This is the support level 1. So there are 3 support zones. This is support 1. This is support 1. This is support 2, this light green. And I don't know if you're seeing or if this thing is visible to you, but you can see over here, this 16552, this is the support 3. So there are 3 support zones and there are 3 resistance zones. So this was first resistance, this was second resistance, and then there is this 17559 level is the third resistance. So this is how it operates. These are basically ready-made support and resistance levels, and this is a pivot level. Now this level today, uh, now if you might have been understanding what I'm talking, the multiple confluences and context thing, that here we not only had a reversal pattern, we not only had overbought RSI, we not only had stochastic telling us to sell, we also had a pivot point right in front of our face. Take that. Now, when all these context and confluences come together, you get a good confidence to trade in markets, right? Despite being the positive market being in a positive trend in super bull market and whatnot, when so many confluences come together, it works. It works like magic. So let's understand it again. Let's see RSI. Let's see RSI. Let's see stochastics, and then this price action reversal pattern. So as you can see, this was the time when our RSI was 85, 86. This was the time when this was actually stochastic actually gave a late signal, but that was okay because that was a confirmation to this particular thing. But with RSI over here, a negative pattern that this candlestick pattern that says this is a negative sign because it closed below this low of this candle. This is a 3 inside down or something. I do not remember the name. I just have to understand the concept of how they work. So, and then we had resistance, pivot resistance point 1 over here. So as you can see, there were multiple confluences that were hitting at that particular point, and that is why markets fell from that point. So when all these confluences come together, it is easy to trade in markets. All right. So pivot points are basically ready-made support and resistance zone based on which you can derive target levels. So these are basically for entering or exiting into trades and deriving target levels. So let's see, like I told you, if we short over here, stop loss over here, the stop loss is not activated yet, which means the trade is still active virtually. This might still be a stop loss hunting. We do not know before if it wants to fall, this might be a stop loss hunting. Our stop loss is over here, so we are good for now. But this level I told you was the next target for me. This was based on price action, which means this was based on purely price action and not based on any indicator. But now the next indicator, this pivot point, what is saying is this level is going to be a target as well. So what happens is in such cases, we have two support levels very close to each other. So there a box is formed. Just a minute. There this box is formed. And this box is what we call a demand zone. Okay. This is how demand zone and supply zone are derived from technical analysis. So because there are multiple context to this chart that this might take reversal from here, this is called a demand zone, which means we can expect buying. We can expect fresh buying in this particular zone, and we can expect people to book their profits, those who are short from these levels in this zone. So this is how the zones are derived from market. So this is a demand zone as of now. What happens when market breaks below this demand zone? When the market breaks below this demand zone, it will head towards its next target. So what were the next targets? If you remember, we talked about this and this level. Now this red line you see over here, this particular pivot point was a pivot point for yesterday. So we do not have to consider this pivot point for now. We only have to consider today's pivot points. So whatever that was in the past were for past. It won't work now. Okay, and even if it did, it would be coincidental. So you do not have to consider the pivot points of past. Only have to see the pivot points of today. So this is where the demand zone is and the buying zone is. And if it breaks below this zone, the possible targets are this 1, 2, and then this. Let me mark it for you, this zone, because it is a support zone. So if it breaks this demand zone, 17,026, 16,995 and 16,968 are the possible targets. But the thing is, you have to consider the fact that markets are in a mad bull run. Like you have to see this uptrend and then ask to yourself that whether are you really expecting markets to come down to these levels today itself. Not saying that it is impossible, it can happen, but you have to take the factorization, you have to consider the fact that market has been in a strong bull trend. All right, so do not just short blindly, you have to take those facts in consideration as well. So this is pivot points, and uh, this is pretty much it. Let's go to last indicator that I have to show you, ADX. Now there's this confusion going on over here. So the way I use ADX is what I'm going to tell you and not how people use it. People use it like they look for this crossover of red and green lines and then they take trades based on it. I completely want to change the settings of this ADX. So the plus DI and minus DI are these lines. I just want to hide those lines. So I'll just make them white. I do not need them. All I want is that black line, which is ADX. What ADX is? Now ADX is basically a momentum indicator. It will not tell you whether the market is going to go up or whether the market is going to go down. It will not tell you that. What it will tell you instead is whether the market is having strength or not. What is the number? So you are the number, some numbers are getting displayed over here. The output value is here. So the thing of ADX is if the value is 25. So when it is about 25 or somewhere below, somewhere near that level like it is right now, it is considered that market is having strength. So for now, see this Nifty market, it was again just a stop loss hunting for new sellers. Our stop loss was over here, so we are intact, and now we are slightly coming into profits. Although this trade might work, but I am reluctant to take such trades, as I said, because it is against the trend. So over here, this ADX is trying to tell you that market has strength. It will not tell you whether it is going to go up or down. It will only tell you whether the market has strength or not. So for now, it is like 25 or so, market is falling, which means market has strength. Anyone that is controlling the market has strength. Who is controlling the markets for now? You tell me. Right, the bears, the sellers, they are controlling the markets for now. And that is exactly what is trying to tell you, that bears are in control and they have strength. So for now, again, let's go to this point where the ADX was 48. Now, when ADX is so high, it says that someone is uh, go. This basically tells you that the something that is, how do I put it? Something that is going very high or low is probably going for a point of return. So whenever the markets with AD in respect to ADX go very high, like the number here you see went up very high, it signifies a kind of reversal that is going to come. You have to see 25 to 40 zone is basically the kind of zone we are targeting. Whenever it's between 25 to 40, we say that yes, it is very much powerful. The trend market has power. Whoever that is controlling the markets has strength. But whenever it goes above 40, it is over exploding. And anything that is just too much is kind of bad. So this same thing happens when it goes way too up or way too down. It actually starts to signify something exactly opposite. Like you might say ADX on 40 or 50 levels is very strong, but it is how the contradictory thing works. On this exactly works opposite, because when it goes on the very upside, it says that okay, the buying might have been done and now it is time for reversal. It does not really show the kind of reversal, but it just shows you that the power. It is kind of hard to explain you how ADX works, but it shows you the kind of strength. Like if the ADX starts to drop below now, like it goes to 15 or so, and at the same time markets went down. Okay, so what it signifies is, okay, it was a complete reversal over here. This particular trend, this particular trade, it just trapped everyone, and now the stop loss is done, everything is done. The reason, again, trend surprises you in ways you cannot even imagine. Yes. So now let's just visualize one particular example where let's see, let's say the markets went down like this and ADX kept going down. So when ADX is going down, it says that whoever that is controlling the markets is losing strength. All right. So if the bears are losing strength and the market is still going down, how is it still going to fall? If the bears are losing strength and the market is still falling, which means the bears are getting weaker, which means the reversal is sooner or later coming. So it goes like this, goes like this. Okay. When market goes up and again the bulls are in charge, and when just bulls go high on charge, like here, it again is a kind of reversal sign that now the bulls have just taken way too over. They have just over exploded and they might now fall. Okay. And that is what exactly happened in the morning. So it was ADX was just way too high, and then this cycle keeps on continuing. So it is hard to explain ADX in technical terms. You have to experience it in when you are trading, but it basically tells you the kind of strength the market has. Okay. So that is it for today. I know this session is way longer than I thought it would be, but I have no hesitation or problem spending time in clearing your basics, because as I said in the last session, if the basics are not clear, you are not going to understand advanced level concepts. So the basic needs to be clear. If you haven't understood anything, feel free to just replay this video until you get clear, because from next session onwards, we are diving into advanced analytics of technicals. So in next session, we'll understand Fibonacci, and then I guess we'll take on the risk management and position sizing, because that is probably the most important part of this particular course. Technical analysis is fine, but let me tell you, without risk management and position sizing, you are not going anywhere. Without risk management, technical analysis, and all those stuff, trading is impossible. Okay. So I hope you learned out of this session, out of this video. And yes, if you have any doubts, then yes, again, please feel free to replay, because until and unless the basics are clear, we are not going to understand further. So this particular session ends our basic technical analysis. From next session onwards, we are diving into advanced technical analysis. So I hope you understood this video and learned something. Okay, so I will see you in the next session. Tata, bye bye, and take care.